Bank of England policymakers not singing from the same hymn sheet. Welcome to Market Insight, I'm Ramzan Karmali. The central bank's chief economist, Huw Pill, today urged caution on rate cuts, while earlier this week Governor Andrew Bailey suggested a faster pace. So why do the two board members seem to be conveying a different message? And what could this mean for policy decisions going forward? Well, to help answer that and more, I'm joined by Chris Beauchamp, Chief Market Analyst at IG. Chris, thanks so much for joining us. So, on the face of it, it looks like Andrew Bailey and Huw Pill disagree about policy going forward, but is that completely fair?
Well, this is interesting because we were looking at yesterday's reaction to Bailey's comments, and it seemed very overdone. From they need to be a bit more activist, I think was the phrase that Bailey used yesterday in cutting rates. And you had this quite substantial move down in the pound against the dollar and against the euro, which didn't seem to back up what the head of central bank actually said. And then you get Huw Pill today, ostensibly saying something different, but actually I think it's very much two sides of the same coin. We are moving in that direction, but we don't want to move too fast because this isn't the US. Inflation isn't beaten in the UK in the same way. So I think the caution is warranted, really, from both ends of the spectrum.
Now, the Monetary Policy Committee meet next in early November, and the markets before today seem pretty set that would get a 25 basis point rate cut. Do you think there's any reason for them to adjust those forecasts?
Yeah, you've got to be a bit more cautious now. I think there's still a lot riding on the next inflation reading, and indeed other UK data that looks at the labour market, really. 25 basis points isn't nailed on, I think, in the same way that you're arguing it is for the US and indeed for the ECB. Once more, it's the Bank of England that looks a little bit at the odd one out, that's really not keen on cutting too quickly. So the field is still wide open, I think, on this one.
So going forward, the easing path, will it be a lot slower than, say, the ECB and the Fed?
On current data, yes. I think there's a strong potential that we don't see a move when it meets again in November. We might get one by the end of the year. But yes, there's not that headlong rush, I think, or let's not say headlong rush, that's unfair on the Fed and ECB, the orderly progression of rate cuts. It's not going to be the same from the Bank of England, really, unless, of course, inflation really starts to come down. But the last couple of months have really pointed to persistence of inflation in the UK.
Now, sterling before Huw Pill's speech was on track for its worst week of the year, but it climbed around 0.1% after the release of the text of that speech. What do you make of the recent moves for the pound?
Yeah, it's been a bit of a one-way move, really. I think what we'd seen over the past week is that drop in the pound against the dollar from 134, mainly because people have been so enthusiastic in pursuing this one, its move higher. People were happy to be long sterling because they thought the BoE was going to be fairly steady. In fact, the message overall this week hasn't really changed. It's just you had Bailey tinkering, if you like, really. It's probably the same message as it was on Monday. So I think it's interesting maybe to watch the pound over the next few days, particularly, of course, as we get the US jobs report, and if that also means that we're likely to see a 25 basis point cut from the Fed, not 50, that will maybe strengthen the dollar a little bit. But overall, I think you still see a central bank that's keen to ease and a central bank that's less keen to ease particularly quickly. And that should continue, I think, to benefit sterling in the short to medium term.
Now, one other comment that Huw Pill made was that high interest rates weren't depressing investment, but it was high levels of uncertainty that were to blame. Do you think he's right?
To an extent, yes, I think. And there's a lot of that uncertainty has been removed with the election, but with the budget still to come, there's that last hurdle, I think, that needs to be navigated. Certainly, not to say the government's been talking the economy down in that way, but certainly it's not been a very enthusiastic start to the Labour administration in terms of everything's doing well. It's more of there's a lot of work to be done. So maybe if the budget changes that, maybe the forecasts aren't quite as bad. That might remove quite a bit of the uncertainty, really. And he's right to say, I think, that it's not really deterred investment in terms of the higher interest rates, I think, because it's not as if the Bank of England is the only place with higher interest rates. I think there's certainly other places, and that's likely to remain the case for a while.
You mentioned there the budget that's coming up. What are you hoping to hear from Rachel Reeves?
Well, I think we'd all like to see maybe a slightly rosier growth forecast. Certainly, maybe the black hole, 32 billion black hole, maybe that won't be as bad as anticipated. That might give her just a little bit of room for flexibility. But I think the reports this week about having to cut infrastructure spending is a bit worrying, because this is a government that said it was going to get the economy moving. And on the face of it, the only way we can do that is through infrastructure spending. And for the moment, they don't really seem that keen. I think, and that's a bit of a worry. So I hope that we get a bit more of a positive spin in terms of spending on big projects to really give the economy a bit of a boost from the state side of things.
Chris Beauchamp from IG, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.